Hugh asks a seemingly innocuous question. He asks, will a rise in interest rates cause a house price crash in the UK? Well, Hugh, never have so few words been so hotly debated and so virtually impossible to answer. We could talk for months about this, literally months. There is no firm answer. Nobody knows. So what I'm going to do is, first of all, I'm going to cop out of your question by saying why you're probably asking it. Then I'm going to cop out of your question by saying why you should be asking it and what you could ask instead. So for the first part, clearly interest rates are at rock bottom lows. I mean, by some measures, interest rates are 300-year lows. Bank of England has never had rates this low before. If you go out and get a mortgage, you don't pay 0.5%, whatever the bank rate is. But you can easily get a mortgage, fixed rate mortgage for 5 years at 3%. Even a first-time buyer can get something between 4 and 5%, which is incredible, incredibly cheap. And so obviously, with house prices going up again, you would be very sensible to think, well, if these low interest rates don't last, what on earth is that going to do? Is it going to cause a crash? But remember that rates were not, normally 3 to 4%. They would normally say 6%. Now, on a £200,000 mortgage, you might be paying, say at 3%, you might be paying about 950 quid a month for a repayment mortgage. If it was to go up to 6%, you would be paying about £1,300. I think that the market can take that. I think that that is not going to cause a house price crash. However, by the time interest rates go up, by the time you can't fix anymore at these low rates, house prices are probably going to have gone up. First-time buyers on the fringes are probably going to be paying more for new houses, or the houses, their new purchases, and they're paying a 6% rate. So you've got two components there changing. So is a house price bubble or soaring house price market and a rise in interest rates going to cause a crash? Well, at some point it will. It always does. But is it going to be in 5 years or 10 years? Will it take the market doubling? These are just really difficult questions to answer, and nobody has a good answer. Everyone has an answer. You can spend all your time on the internet chatting to fellow bulls or bears, but none of them really know. So the second thing that I would say is it's probably better to look at why you need to know that. If you're an investor and you're investing, say, in house builders, figure out how their business will change as interest rates vary. If you're investing in banks, figure out what kind of exposure they've got, and as house prices go up and down, how does their asset and liability situation change? If interest rates go up, they might make more profit, for instance, which might offset a bit of bad debt. So swings and roundabouts there. And if you're thinking of this as a homeowner, really you've got to always think, can I afford this house in some quite bad outcomes? If I lost my job, say, could I afford for 3 to 6 months to pay the mortgage? If rates went up, could I carry on paying? Should I fix now? You can fix for 5 years, as I say, at 4% or even 3%, so you can insulate yourself from some of these problems. So I think you need to drill in a little bit, if I may say, figure out a little bit more why you want to know if interest rates will cause a crash in the UK, and understand that what seems a really simple question, and don't get me wrong, you can ask a man in a pub tonight and he'll say yes, you can ask another man and he'll say no. It's a very easy question to answer, but it's not an easy question to answer correctly. Nobody knows. If you have any other questions, or you just want more information about this kind of thing, be sure to check back at the Motley Fool website, which is at fool.co.uk. And until the next time, invest on.